Hey everyone, welcome to this explainer. If you're a finance student scrolling YouTube right now, or honestly just someone who loves geeking out over the actual mechanics of global economics, you're exactly where you need to be. We're going to dive straight into the hidden financial gears turning behind the recent headlines about US gold reserves. We're cutting right through the usual political noise, and we're looking strictly at the balance sheet. Because, when you strip away all that drama, what we're really looking at is a fascinating, high-stakes masterclass in sovereign debt accounting and asset valuation. So, you've probably seen the news. Donald Trump recently demanded a full physical audit of Fort Knox. Now, the media almost always frames this kind of thing around those classic conspiracy theories, right? The whole, is the gold even still there narrative. But here's the thing. Whenever any politician suddenly gets super interested in financial transparency, especially at a sovereign level, we really need to stop and ask why. I mean, sovereign transparency is rarely just about counting gold bricks. It is almost always the setup for a strategic financial maneuver. As finance students, we've got to think critically here. Is this just a political stunt, or is there a massive accounting motive hiding right there in plain sight? Let's unpack the numbers. Section 1, the Fort Knox audit. Okay, let's talk about the sheer scale of this asset. $650 billion. That's what we're looking at here. Officially, the United States owns about 261 million troy ounces of gold. That's over 8,100 metric tons. And of that total, roughly 147 million ounces are sitting securely in the Fort Knox depository in Kentucky. The rest spread out across places like the West Point Mint and the Denver Mint. Now, if you take that massive physical stockpile and multiply it by today's gold prices, the market value blows right past $650 billion. To put that into perspective for you, that's like having the entire GDP of a mid-sized European country just sitting idle in a vault. But here's where it gets interesting. Having a massive physical asset is one thing, but how you actually report that asset on your official financial statements, well, that's a whole different ballgame. Section 2. A $650 billion discrepancy. This is where things get genuinely wild. On the U.S. government's official balance sheet, that immense 261 million ounce stockpile is still valued at a statutory rate of just $42.22 per ounce. Yes, you heard that right, $42.22. It's basically a book value relic from 1973, right after the Nixon shock ended the Bretton Woods system, officially decoupling the U.S. dollar from gold. That statutory price was modified one last time, and it has literally just sat frozen there ever since. But out in the real world, actual physical gold on the open market today is hovering around $4,500 an ounce. So think about this. You've got a prime sovereign asset, officially recorded at less than $50 an ounce, while the real-world market is willing to pay thousands for it. It's an accounting anomaly of epic proportions, and it completely skews the reported health of the national balance sheet. Section 3, the real estate analogy. To really grasp how absurd this is, let's bring it down to a personal finance level. Imagine this. Step 1, you buy a house back in 1970 for $40,000. Step 2, a few decades pass, the neighborhood absolutely booms, and the true market value of that exact same house shoots up to $4.5 million today. Pretty great, right? Now, step 3, you go to a modern bank to apply for a massive loan or a line of credit. But for whatever reason, you insist on keeping that house on your personal balance sheet at its 1970s historical cost of $40,000. When the bank evaluates you, they're looking closely at your loan-to-value, or LTV ratio. Based on that stated 40K book value, your LTV looks terrible. Your borrowing power is severely constrained. On paper, you look way less wealthy and way more leveraged than you actually are. And this brilliantly illustrates the sheer power of an appraisal. If you get a certified appraiser to come out, which, by the way, is essentially what a physical audit is for Fort Knox, you mark that asset to market. By simply updating the paperwork from that $40,000 book value to the $4.5 million appraised value, you instantly look exponentially wealthier. Your debt-to-asset ratio plunges. And here is the absolutely crucial takeaway. You haven't added a single new brick to the physical house. You didn't buy any new property, but just through a simple update in accounting reality, you have completely unlocked a massive amount of wealth and borrowing power. It's a purely administrative stroke of the pen, but it changes the whole shebang. Section 4, accounting for national debt. So let's take that real estate logic and apply it to the sovereign level. What actually happens if the U.S. government decides to officially revalue its gold? If an audit happens and the U.S. marks its 261 million ounces to current market prices, the macroeconomic ripple effects are just profound. Let's break down the mechanics, because this is where the real finance magic happens. Under current law, the Treasury has the authority to issue gold certificates to the Federal Reserve. Right now, the certificates are pegged to that outdated $42.22 price. But if the gold is officially revalued to a market price, say $4,500 an ounce, the Treasury could issue brand new gold certificates to the Fed for the difference in value. The Fed receives those certificates and in exchange, mathematically credits the Treasury's general account with hundreds of billions of dollars. Just think about that for a second. The Treasury essentially gets an injection of hundreds of billions of dollars out of thin air. They don't have to issue a single new Treasury bond to the public, and they don't have to raise a single cent in taxes. First, it instantly adds hundreds of billions in paper assets to the Treasury's ledger. Second, it creates a fundamentally stronger national balance sheet by drastically improving the sovereign asset to liability ratio. Third, just like the homeowner in our analogy improving their LTV, a stronger balance sheet instantly increases national borrowing power. And finally, it unlocks massive financial flexibility for managing the national debt ceiling. It allows the government to fund operations without triggering those immediate, messy political showdowns over bond issuance. It is quite literally a giant financial accounting trick hiding in plain sight, just waiting to be utilized. Section 5. The real motive. So as future finance professionals, we really need to shift our focus away from the internet conspiracy theories about empty vaults. We have to look at the strategic financial maneuver being proposed here. The source text actually puts it perfectly. Forget whether the gold is missing. The bigger question is, what does Trump plan to do if it's all still there? If the vault is full and the gold gets revalued, it provides a massive, massive lever for debt management. Will America finally open the vault, or is the strategic revaluation resulting from the audit the actual endgame all along? It's honestly a masterclass in how recognizing true asset value can alter financial reality without changing a single physical asset. But I'll leave you with this one final, provocative thought. If the United States does open the vault and officially marks its gold to market, fundamentally altering its sovereign debt ratio overnight, which country will be forced to follow suit next? Thanks for joining me on this explainer, and I'll catch you in the next one.